What are the tax treatments of the different structures? So the taxation of the different structures is directly relevant to the selection. While it is often easy to say just go LLC, there is more to reflect upon. So let's take a look at the sole proprietorship. So this is taxed as an individual entity. The individual reports the results of the activity on what's called a Schedule C. Specifically, it's called Form 1040 Schedule C, and it is incorporated into his or her individual tax return, the 1040. A sole proprietorship cannot be a hobby, okay? There's a concept of hobby losses. Now, if the activity is a activity that regularly generates losses, then the IRS says it's a hobby. Hobbies are not businesses. Businesses should generate profits. The losses of hobbies are not deductible against other income. To avoid being treated as a hobby must produce income in 3 of the last 5 years. Now, let's just pause there for a moment. Because a LLC, a partnership, and a corporation can produce losses for a very long time and not be treated as hobbies. Interesting. Okay? Interesting. So let's not miss that. Hobbies are a specific thing to sole proprietorship. S-Corp. Remember, this is just a corporation. It's legally a corporation. Has all the rights and privileges of a corporation. The tax status of the corporation has nothing to do with the legal status. It's a tax filing position. So the S-Corp allows the company to be taxed at the shareholder level. It's called a pass-through vehicle. So the income of the company passes through to the shareholders. Now, there are certain qualifications that you have to be a corporation that can elect S status. What the income does, well, you have to make the selection 2.5 months after the year starts. So for calendar year, it's by March 15th. What's the point? The point is, if you're an S-Corp, then the income's reported by shareholders in proportion to their ownership interest. This is where the flexibility of the limited liability company is better, because I can report income based on one thing, I can report losses based on another agreement, and I can report my equity on a third. At the end of the day, they have to harmonize, but in the interim, this capacity to move income around is huge. S-Corps don't have that capacity. Simply put, whatever your percentage ownership is, that's what you got to pick up as income. Now, the income of the corporation reported by the shareholder in proportion to their interests, and so this is a nice little illustration here of that lack of flexibility. S-Corp, C-Corp. Corporation start as C's, you can elect to be S. Going back and forth is a bad plan. Let's move on to partnerships. Again, this is your introduction here. Partnership files a separate tax return known as a 1065, but the income is reported by the partners. Income for individuals working in a partnership will generally be treated as self-employment income. All of the income reported by a partnership for individuals working in the partnership is self-employment income. Now, this is different from the S-Corp, where only the compensation, because the S-Corp is viewed as a separate entity from the owners that are now employees. In a partnership, owners are not employees. They are owners, and they are partners, and they are proprietors, and as such, they get draws. They don't get compensation. Structurally different. And it can have some very important tax rate planning ideas. If you reflect on lecture 1, you'll reflect on the fact that Medicare is 2.9%. It is imposed upon all compensation. And so in an S-Corp, I can reduce the amount that's compensation, treat the balance as ordinary income, subject to a dividend, but it's still single tax, and now it's not compensation, no Medicare tax. I just saved 2.9%. Don't miss that. Basic planning. So characterization of income is a big deal. Partnerships tend to have self-employment income. Corporations, S-Corps, have wages, and then they have ordinary income. Now, there are significant flexibility for allocation of income and expenses. Income can be allocated to the working partner. Expenses can be allocated to the investing partner. The investing partner put up the money for the startup expenses. He gets the losses. When there's income, then the income partner can be the working partner. Now, when the partnership ends, this is important. The partner's capital account need to reflect this allocation. So the income partner has a positive account and gets this in liquidation, and the expense partner has a negative account and has to give the money back. It's a nuance. I need you to know it. This is a concept called substantial economic effect. And the allocations have to mean something economically. So if I take all the losses, I can't then claim I own 50% of the company because my capital account should be lower than somebody else's capital account that didn't take the losses.